Hello, students. Good morning. Today we will discuss the chapter 4. Here is the chapter 4, and the topic is the advanced topic in risk management. So, let's start. The field of risk management is undergoing monumental changes. Risk managers must understand financial markets and be able to effectively incorporate quantitative analysis and technology in their risk management program. Millicent Workman's CPCU Research Analysis International Risk Management Institute IRMI and editor Practical Risk Management. So here is the what is the learning objective. After studying this chapter, you should be able explain the meaning of financial risk management and enterprise risk management. Describe the impact of the underwriting cycle and consolidation in the insurance industry on the practice of risk management. Explain the securitization of risks, including catastrophe bonds and weather options. Explain the method that a risk manager employs to forecast losses. Show how financial analysis can be applied to risk management decision making. Describe other management tools that may be of assistance to risk managers. So, this is the key feature of this chapter 4 advanced topic in risk management, and this key feature you will learn from this chapter 4. Hopefully, it will be very helpful and enjoyable when you're reading this chapter 4, because it is very essential for advanced to go to. It is a very essential for from basic to advanced go to the next step of this insurance, the risk insurance management. Hopefully, it will be a very important chapter for every insurance students. Here's the some summary. So you should read this. I skip this topic. Now I start this or discuss this. The changing scope of risk management. Traditionally, risk management was limited in scope to pure loss exposures, including property risks, liability risks, and personal risks. And interesting trend emerged in the 1920s. However, as many businesses began to expand the scope of risk management to include speculative financial risks, recently some businesses have gone a step further, expanding their risk management program to consider all risks faced by the organization. Financial risk management. Business firms face a number of speculative financial risks. Financial risk management refers to the identification, analysis, and treatment speculative financial risks. Their risks include the following. Here is the some three key features. The number one is commodity price risks. Number two, interest rate risks. Number three, currency exchange rate risks. So commodity price risks. Commodity price risks is the risk of losing money if the price of a commodity changes. Producers and users of commodities face commodity price risks. For example, consider an agricultural operation that will have thousands of bushels of grain at harvest time. At harvest, the price of the commodity may have increased or decreased, dependent on the supply and demand for grain, because little storage is available for the crop. The grain must be sold at the current market price, even if that price is low. In a similar fashion, users and distributors of commodities face commodity price risks. Consider a cereal company that has a promise to deliver 500 boxes of cereal at a grid often prices expand if the maintain the price of a grain, a commodity needed to produce the cereal may increase or decrease, altering the profitability of the transaction. The first part of Exhibit 4.1 shows how future contracts can be used to hedge the commodity risk, price risk. The next one is the interest rate risks. Financial institutions are especially susceptible to interest rate risks. Interest rate risk is the risk of loss caused by adverse interest rate movement. For example, consider a bank that has a lot of money at a fixed interest rate at home. Purchases under 15 to 30 years mortgages. If interest rate increase, the bank must pay higher interest rates on deposits while the mortgages are locked in the lower interest rate. Similarly, a corporation might issue bonds at a time when interest rates are high for the bonds to sell at the face value when issued. The coupon interest rate must equal the investor required rate of return. If interest rates decline, the company must still pay the higher coupon interest rate on the bonds. The last one is currency exchange rate risks. The currency exchange rate is the value for which one of the nation's currency may be converted to another nation's currency. For example, one Canadian dollar might be owed the equivalent of the two-thirds of an US dollar. At this currency exchange rate, one US dollar may be converted to one and a half a Canadian dollar. US companies that might be international operations are susceptible to currency exchange rate risks. Currency exchange rate risk is the risk of loss of value caused by changes in the rate at which one national currency may be converted in another currency. For example, the US company faces currency exchange rate risks when it agrees accept a specified amount of foreign currency in the future as a payment for goods sold or work performed. Likewise, US companies with significant foreign operation face an earning risk because of fluctuation exchange rate. When a US company generates profit, about it, those gains must be translated back into US dollar. When the US dollar is strong, the foreign currency purchase fewer US dollars and the company is earning therefore and lower weak US dollar. That is when it has low value relative to a foreign currency, means that foreign profits can be exchanged for a larger number of US dollars and consequently the firm's earning are higher. So today our topic is end. Today we start our chapter 4. So take care everyone. See you tomorrow. Bye bye. Now.